Friday, June 16th, 2023. Welcome to this week's Shore Report. My name is Jendrejczak from the Shoreview Real Estate Team powered by New Street. And this week, we're discussing how the provincial government in Ontario is working towards holding up their promise of building 1.5 million homes. Also discussing what the US inflation slowdown means for Canada and some stats behind the steep decline in Canadian mortgage growth that we've seen over the last year since we've seen the interest rate move up. Let's go. The Ontario government is granting more power to mayors in 26 municipalities to tackle the housing shortage. This step is aimed at speeding up housing development and achieving the goal of constructing 1.5 million new homes by 2031. Initially, this was given to mayors in Toronto and Ottawa in 2022. The strong mayor powers allow them to reject local bylaws that could hinder housing construction, aligning with provincial priorities. To qualify for the extended powers, the municipalities must have a current population over 100,000 or be projected to reach that number by 2031. Additionally, they need to have had submitted a housing pledge to the province. While this move aims to expedite housing development, it raises concern regarding the balance between municipal and provincial authority, potentially impacting local democracy and community involvement. Nonetheless, the government's focus on empowering municipal leaders and providing practical solutions highlights its dedication to ensuring the success of housing initiatives and ultimately reaching that 1.5 million goal by 2031. The US Bureau of Labor Statistics has reported that inflation has slowed in May, reaching its lowest rate in 2 years. This decline is mainly due to lower prices for energy such as gasoline and electricity. However, certain areas of household expenses have not seen significant improvement, which is a cause for concern. The CPI Consumer Price Index increased by 4% in May compared to the previous year, a decrease of 9.9% from the 4.9% in April. So it's gone down a little bit. This information provided by the US Bureau of Labor Statistics regarding the slowdown in inflation and the mixed trends in household expenses can offer some insight into potential impact of inflation numbers for Canada. In terms of mortgages, Canadian mortgage growth in the first quarter of this year has actually hit a 20-year low, according to a report by BMO. The report highlights a significant slowdown in mortgage borrowing in Canada, primarily due to the Bank of Canada's interest rate hikes. This suggests that higher borrowing costs have had a dampening effect on mortgage demand, and the increase in household debt-to-income ratio and debt service ratio indicate a growing burden on Canadian households. Despite the recovery in household net worth driven by the housing market and equities, the report underscores the vulnerability of household debt to the Canadian economy. This implies that policymakers need to be very careful and consider further tightening measures to address this ongoing concern. In summary, here are the highlights and main takeaways from today's report. Number one, strong mayor powers may help with addressing the housing crisis, but they raise a concern about the balance between municipal and provincial authority. Number two, US inflation slowdown and mixed trends in household expenses could potentially impact inflation numbers in Canada. A decrease in inflation should help with balancing out interest rates and seeing the market stabilize overall. Number three, the decline in Canadian mortgage growth indicates the dampening effect of higher borrowing costs, highlighting the vulnerability of household debt to the Canadian economy. Moving forward, policymakers need to be very careful when considering further tightening measures. Hope you enjoyed this week's short report. Lots of changes, lots of opportunities. Stay informed, and thank you for tuning in.